Hi, welcome to the 36 South end of Q1 update video. My name is George Adcock. I'm the head of trading and a member of the investment committee. We're making this video as a follow-up to the first video that we made in January. I'll put a link on the screen for those who haven't seen it. There are quite a number of linkages between today's video and the original one. When we think about like the content from the first video, we were really predicting kind of a tougher macro environment for risk assets. And that was really coming from kind of three main kind of areas. And those areas were kind of like very, very lofty expectations that had been priced into the market in terms of asset price appreciation, especially within stocks, with relatively high positioning against those kind of a growing cyclical weakness that we could see within the kind of market internals against some of these expectations, and a kind of declining liquidity picture that was going to weigh on assets over time. Now, the charts made in this pack are taken at the end of March, and there's been quite a lot of movement since Trump's tariff announcement. And I will try and make some comments on that as we go through the presentation. But the idea is to give you a broad-based look at how kind of this cyclical story is evolving and what that might mean for kind of assets going forward. If you could take a quick moment to read the disclosure on the page, that would be great, and we'll get on with the content. If we just go over some of our kind of observations from the first video, one was that kind of like, growth expectations had really, really shifted higher relative to the last couple of years. The chart on your first page here shows the growth expectation coming into the year. So you can see that coming into 2023, growth expectations were 0.3. And against that, the economy actually delivered 2.9% in the US. We saw this kind of like rise into kind of 2024 at 1.3, which is the red line, and the economy delivered 2.8%. And this year, we can see that coming into 2025, expectations had really risen to 2.1%. Now, what's interesting is if you look back to 2022, which would say, let's say, the kind of start of this kind of cycle, what we had seen is that the market had got itself very, very entrenched with negative expectations. We had a Bloomberg model that was predicting 100% probability of recession coming into 2023. We had things like the BAML Fund Manager Survey showing the highest cash exposure of investors ever. If we shift that forward to today, we sort of seeing kind of like the opposite side of the pendulum. And what we started to see is, the lowest fund manager survey cash reading kind of in history. And, things like the Blackstone did a survey of their companies, and they really showed zero chance of a recession. That was what came out in the survey. And when you get these like very large shift in expectations, this is when you tend to get kind of quite large asset repricings. And that's what I think we've started to see coming into this year. This was a chart that we've showed in the kind of the first video, and it's just to kind of look at kind of the correlation between some of the asset prices and kind of these kind of expectations. And what you've got on the top chart is the MSCI World in log, which is the kind of dark line. And then on the bottom, you've got kind of the net number of kind of participants of the conference board who expects higher prices versus lower stock prices. And what you see is that when this gets to kind of a 30% net, which is marked by the red lines on the chart, you get this kind of like situation where expectations are so high and the market has to kind of grow into those expectations. And when we think about kind of, as stated before, when we think about the expectations and kind of repricing of assets, this is kind of quite a good like visual way of showing it. Now, in our world of 36 South, what we tend to find is that when we get a downside surprise versus those expectations, that's generally quite good for volatility. And we've seen that kind of in the kind of 2000 to 2002 period on the kind of left hand side. It was especially prevalent in this kind of 2018 period, which would be kind of the third line along. And coming into kind of the first quarter of 2025, we've seen kind of like quite a significant pickup in volatility. We've seen credit spreads start to widen quite materially. And that's really like the market moving from a kind of a situation with very, very high expectations, more towards having to rebase to where kind of like reality is. One of the reasons why we talked about kind of like cyclical weakness in the economy when others were quite buoyant was that what we'd started to see is that the momentum was coming out of the leaders of this cycle. Now, in general, what you tend to see in the kind of market is you tend to see like quite good correlation between services and manufacturing data, which kind of capture these kind of upswings. Now, what we've seen in the last couple of years is kind of a deterioration in the correlation between the manufacturing and the services data, which has made measures like ISM a lot less reliable. And what it's paid to do is really focus on the internals of the market and how the US consumer is behaving. Now, in this chart, what I've done is I've taken the market leaders of the cycle, which were kind of semiconductors, housing, and industrials, that were really kind of driving the market higher from a cyclicality perspective. And then I've charted them against kind of beta on the top chart, which is S&P, and on the bottom chart is kind of equally weighted S&P. And what you can see is that it has a kind of like pretty good cyclicality to it that kind of is a relatively good determinant of like where we are in the kind of business cycle. And throughout last year, what you were starting to see was that these kind of were sequentially starting to deteriorate versus beta. The first thing that we started to see in the middle of last summer was that semiconductors were relatively weak versus beta. And then post kind of the Trump election, we had started to see that housing was starting to deteriorate as rates rose. And quite a lot of the kind of backlog in housing had been kind of passed through the system, which was quite different to the situation we were in 2022, when the market was expecting kind of very, very, very poor growth. And the final part we started to see is we started to see industrials really decline versus beta. And that gives you kind of this composite chart in front of you where you can see that the cyclical growth in the economy is actually like now like quite negative when we use the kind of internals. If we take these kind of three observations that we made in the first video and we look at kind of like what's actually kind of happened, you can see that, running into the election and into the inauguration, growth expectations had really been surging. And the chart in front of you basically takes the quarterly kind of analyst real GDP expectations and seasonally adjusted and annualizes them. Now, the blue line, which you can see is for Q1 kind of annualized, and you can see that relative to expectations, there's been a very, very big kind of like rebalancing back to maybe closer to where 36 South's view was, that the cyclical momentum was coming out of the economy and that, we were going to have a kind of somewhat of a growth slowdown. Now, obviously, one of the parts of this has been the kind of very large uncertainty that's been driven by the Trump administration's kind of trade policy. And we do now have a bit more certainty on that. But what we've seen is really the pendulum swing from a very, very aggressive, very kind of positive expectation more towards kind of middle. And now you're starting to see that we're getting downgrades in growth from many people across the street. And you're starting to see kind of recession expectations pick up within the marketplace, where this kind of divergence of opinion is now sort of like somewhat playing out in the market. And what's important is now to understand, is this something that's going to manifest into something larger? And what we'll do is we'll look at kind of by triangulating kind of a number of different things that we see in the market, we'll be able to give you like a little bit of a better picture by the time we get to the end of these slides. One of the things that I kind of mentioned earlier was that one of the real kind of strong points of the US economy had been the US consumer, and watching the US consumer data had been a very, very good way to kind of filter out some of the noise that you'd seen in this cycle. And there were different ways of doing that, kind of like through tax collections, kind of spending. Now, for the first time in quite a few years, we're actually starting to see the consumer as kind of like a somewhat of a drag on the economy. And what's been interesting is in the last couple of years, you've seen the low-end consumer has been very challenged, and the high-end consumer has been like buoyed very much through asset price appreciation. And now you're in this situation where there's some level of reflexivity, where as asset prices have started to fall from this kind of repricing of growth and kind of like quite aggressive trade policies from the Trump administration, that's now eating into the higher end of consumer. The chart in front of you is kind of a visual illustration of that. And what it shows you is the kind of contribution of consumer spending kind of chunk to the Atlanta GDP Now forecast. And you can see that through the kind of quarters, kind of this is since kind of the end of 2022, you can see that we've gone through situations where the consumer has generally been like very accretive to kind of real GDP. And for the first time in Q1, we've started to see that that's really starting to wane. And actually now the consumer is now a drag on growth. And that's actually quite a concerning sign, given that we're in a kind of policy regime world where, due to the level of the uncertainty, the Federal Reserve is kind of like a little bit more constrained to act. And we're starting to see signs from the administration that they're less concerned about things like the equity market and more concerned about the financing rate. When we try and kind of look at this kind of broad based across the economy, it's very useful to use kind of leading economic indicators and see what they are saying about the business cycle. The chart in front of you basically shows the OECD leading economic indicators kind of growth diffusion, so the number of countries or the proportion of countries that are growing on the top chart, and the bottom chart basically shows the amount of those countries that have accelerating growth. And what you're starting to see is that, relative to these expectations that, growth was going to be strong ahead of us, actually the leading economic indicators actually suggest that most of the strong growth is actually behind us. And that's another thing where like kind of what's happening in the world versus expectations are having to come together. And kind of as mentioned before, we're starting to see kind of growth outlooks deteriorate, kind of like from some of the banks, and we're starting to see kind of like recession fears kind of mount. Now, given the level of kind of investment that we've seen in the economy and like very, very high allocation to things like stocks, and the fund manager survey by Bank of America is a very good proxy, where we have like very, very low cash levels. Investors aren't very well prepared for this kind of environment ahead of us. During Q1, we've really started to see that play out in asset prices. And since the tariff announcements earlier this week, what we've started to see is that this has become a bit more embedded, where the perception about growth, especially in the rest of the world, is being catalyzed lower through the tariff announcement. And we'd started to see signs of this, earlier in Q1, and we did a breakfast with some of our investors, where we showed that higher beta assets like Bitcoin were no longer trading as well as they had been. And actually, we saw Bitcoin kind of have a news failure peak into the Trump inauguration on like very, very positive news flow. And what that's doing is those higher beta assets are giving you kind of like a little bit of a glimpse into the future. And they're showing you that kind of weaker times were ahead for things like equity returns. Now, one of the things that we think has been relatively interesting at 36 South, and I mentioned this on the previous slide, was that the administration seems to be kind of striking what we used to be called kind of like the Fed or the Treasury put far, far lower. And that really changes the kind of buy the dip behavior that we've seen in markets kind of the last 10 years. And this recent kind of quote from, I think, Donald Trump really kind of sums this up. And this was kind of in the middle of Feb. And he said, "What I have to do is build a strong economy. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We go by quarters, and you can't go by that. You have to do what's right." And that's a very different mantra than investors have learned to live with for the last decade. And that's going to take, again, some kind of rejigging of expectations about how people run their portfolios. Now, when you use any leading economic indicator, it's kind of interesting to see whether other parts of data across the kind of the world corroborate that. On the next slide, what you'll be able to see is that I've taken some data from the World Gold Council about gold demand, specifically related to, let's say, more like the technology sector, which is really into this kind of semiconductors world. And what you can see on the chart in front of you is that World Gold Council data tends to suggest that this weakness is quite real. And, we look at that by saying, okay, the blue line is our growth diffusion from the OECD numbers, and our kind of like gray and blue lines are kind of like what the World Gold Council are seeing. And what you can see, especially in kind of like the last kind of 10-ish years, is that the correlation between these data has been really, really like nice and strong. And they're again reinforcing this kind of view that we had, that cyclical outlook is still relatively negative, and the market is still going to need to price that. Another way to look at this is to try and isolate parts of the economy that kind of, let's say, exposed to the growth or activity of the economy. And so in this chart, what I've done is I've made a basket of air freight and logistics companies. And then again, I've compared them to kind of beta. And what you saw is, if we go back to, and we just focus on the kind of moving average, the red line, we had this very big pickup from 2020. Everyone's at home ordering things on Amazon. The economy starts to kind of improve. And by the end of 2021, we had these like very, very high expectations that were starting to kind of roll over. And we had kind of like a growth downside look. And then we had this kind of like quite shallow recovery from 22 to 24, which, as noted earlier, has become much, much more challenging to time and kind of view through the data. And what we started to see is actually like even in this kind of air freight and logistics data, despite the strong consumer, that this has really started to roll. And the market internals are now starting to reflect this kind of slightly weaker or kind of, growingly weaker kind of cyclical growth picture. Another factor that had been like very prevalent in kind of driving this cyclicality is the effect that fiscal policy has been having on the world. And since 2020, we've shifted from kind of like, let's say, pre-2020, a monetary policy focused framework, to now a monetary and fiscal policy framework, something that Bridgewater have labeled kind of like monetary policy 3. And so it's very important to understand like kind of what's happening in these kind of like fiscal flows from kind of an impulse perspective. Now, the chart in front of you shows the US Economic Surprise Index. And what this does is it measures where data is coming out relative to expectations. And the bottom chart shows you the fiscal impulse using some of the US Treasury data. What you can see is that, generally when we've had strong fiscal impulse, we've had generally quite strong data. And when we've had relatively kind of low fiscal impulse or negative fiscal impulse, the data has tended to deteriorate. Now, when we look at kind of like the recent kind of observation periods, we can see that coming into the election, the Biden administration was really, really kind of like juicing this fiscal impulse, trying to kind of like make the economy look, as good as it could. And now we're kind of on the other side of that. We've got this kind of like reverse effect, which some people call like a bullwhip effect, which is starting to pull down activity in kind of like the US in general, and is only going to act to kind of exacerbate some of the cyclical dynamic that we saw in kind of the previous charts. Another factor that we have to kind of try to account for here is like the effect of Doge, and Doge is trying to cut some of this kind of fiscal wastage. And from what we see so far, from what Elon Musk has released, that this wastage was kind of like very widespread. But this wastage really ends up on private sector balance sheets, and we have to kind of factor that in, that this is going to be like a relatively large tightening coming from the fiscal side if they continue to follow through with the policy of kind of removing this waste and cutting $1 trillion from the fiscal deficit. One of the other things that we had started to see during January, which quite surprised us against this kind of cyclical outlook, which was quite negative, we've started to see things like the US ISM manufacturing start to pick up. Now, in hindsight, I think that this really has been driven by kind of preemptive tariff flows. And in our data, we generally haven't seen kind of like this pickup in activity. And this is another way of kind of measuring it out of kind of like the commodity markets. And what we do is we take kind of energies and metals and compare them to maybe an asset that shouldn't move with the cyclical dynamic. And what you can see is that on the charts, the dark lines, which reflect kind of the internals of the commodity markets, aren't reflecting the pickup that we were seeing in the US ISM, which is the chart beneath. If anything, these are actually being like deteriorating further, and that continues to point to this kind of idea of kind of like relatively lackluster cyclical growth. So when we are triangulating all of these things from all these different angles, we continue to get a relatively clear picture of a relatively benign, poor cyclical outlook for the economy, where the business cycle kind of more globally is being kind of pressured lower from tariffs, from kind of a kind of growth peak. Now, one thing to bear in mind on commodity pricing is that due to the tariffs, there have been quite a few distortions priced into commodity markets. And some people, I think, have misconstrued some of this price kind of movements for strong economic momentum. A good example is copper. Copper has surged higher to all-time highs in America in the kind of COMEX contract. But what is kind of the lesser known story to the wider street is that the arbitrage between the rest of the world price and copper in America blew out to 17% due to expectations that there was going to be tariffs imposed on copper. And what that does is it really kind of almost gives you like a false price signal existing in the market. Now, when we have these charts in front of you, these are really using kind of like rest of world prices, and it gives you a kind of really good idea of kind of like where the global cyclical economy is at. And for now, that continues to look pretty lackluster. Moving on to kind of like some of the dynamics that have been happening kind of like in the interest rate markets, one of the things that we talked about in the first video was the idea that conditions in the interest rate market were like very, very tight. We had a very low number of interest rate cuts priced in relative to where kind of like Fed funds or 2-year bonds were pricing. And that was going to have a kind of tightening effect on the economy. And, it was our argument in January that this was kind of the tightest policy had been actually in quite a while, because the previous dynamic had been tightening gets kind of priced onto the economy. And what we start to do is the forward market start to price interest rate cuts, which has a kind of forward stimulative effect. And that really wasn't happening at the start of this year. Now, what's been really interesting is to see kind of like how this has developed. Now, I have to explain the chart kind of in front of you, and I hope I do kind of a good job. What we had been seeing, the dynamic or the correlation that we had been seeing, was that when financial conditions tightened, so that is generally driven by kind of credit spreads, stock market, the dollar, and 10-year yields, we had started to see a situation where the market would instantly price lower inflation, and against the lower inflation and tight FCI would instantly price interest rate cuts. Now, the chart in front of you, what it does is the red line is our financial conditions. And in this case, this is the dollar and 10-year yields. And on the kind of the dark blue line is the number of interest rate cuts priced into 2025. And the kind of gray blue line is the inflation swap for the 1 year period. And what you can see is that these have been like very, very correlated. And more recently, as we've come into this year and as kind of like tariff anxiety has grown, what we've started to see is that like there's quite a large decoupling here, where elevated inflation expectations due to tariffs are effectively kind of like, and a relatively benign Fed are really preventing the market from pricing interest rate cuts into December this year. Now, the effect of this has to put like a very, very large tightening, okay, versus today's inflation pricing on the market in general. And when you kind of again go back to kind of triangulating all of these things together, what you've got is you've got a cyclical outlook that is somewhat deteriorating. You've got a kind of expectations outlook, which is shifting to a point of kind of slower growth. You've got kind of liquidity that's like relatively tight. And then against this, you've got an interest rate outlook that is kind of almost like pouring gasoline on the fire and kind of exacerbating all of those effects. Now, post kind of like, let's say, the tariff data, what we've started to see is that we've seen kind of like a weaker dollar and kind of rallying tens, which is going to ease some of that FCI. But against that, we've had, like very much wider credit spreads, and kind of stock prices have been far lower. And again, it's kind of like creating like quite a large tightening, especially on the high end consumer that we noticed earlier in the data had started to suffer. If we bring this all together into what it means kind of for assets, we can kind of see some like relatively kind of established correlations. Now, when we think about kind of the sequencing about how some of these things should work, what we should see is, if we go through the panels of this chart, is we see the parts of the leading economic indicators in the OECD that are growing, okay, start to slow. The growth rate of that growth starts to slow, which is our top panel. We then see the actual diffusion of the number of those who are actually growing, is our middle panel, starts to roll over. And then against that, we tend to see that the outlook for especially things like the equity market start to deteriorate. And on the bottom panel, what I've done is I've taken kind of like the all country world, like total investable index. So like all of the stock markets that you're kind of available to kind of invest in. And I've run the global MACD, which is a kind of a measure of price momentum. And what you can see is that basically as the kind of growth picture deteriorates, this MACD starts to deteriorate into a kind of like negative position. Now, the effect of this is generally like substandard equity returns. And obviously coming into kind of like this year, we've started to see a little bit of that in the US. Europe has been a relatively strong kind of area, and even that is now starting to unwind. And if we were to kind of like take a sample set of what this kind of global MACD being negative tends to mean, is it means that for, a 1 to 2 year period, you are generally getting substandard returns where you don't have kind of like nice trends to ride. Now, from 36 South's perspective, these are generally periods where you're going to see increased periods of volatility, and the attractiveness of hedging some of that volatility, or less buoyant equity exposure is very attractive. Now, what we have seen is, and we've been quite surprised by, is that given this outlook, volatility has remained relatively cheap. The charts in front of you go out and they price, a 1 year 80% put price just on a very linear Black-Scholes calculation, And you can see that, relative to periods, that these have been still, relatively cheap. Now, these were run at the end of March, so there'd be like a bit of picking up on the post-tariff period. But, if we run back through the kind of concept here, we've continued to have a skew to the downside due to high expectations and kind of like the positioning that had been in the marketplace. We have a less supportive administration that are reducing the buy the dip behavior and really focusing on the finance rate and not the kind of like equity price. And then thirdly, you've got this kind of cyclical outlook with kind of like challenging liquidity dynamics that are working against pricing. And to us, that means that, like hedging is a relatively attractive thing to do. With that as kind of your backdrop, we still think there are kind of like quite significant pockets of value in and ways that you can do that. Moving on to something that we wanted to kind of show, which is a little bit kind of like more asset specific. We trade quite a lot of currencies here at 36 South, and we try and monitor kind of like longer term dynamics which may drive currencies where we can benefit from them for our investors, or currencies that may fit into kind of a tail risk type strategy or a kind of risk premium type strategy. And one of the things that we've noticed is that from a variety of angles, there seems to be potentially a trade set starting to set up in the Swiss franc that may unfold over, like a longer period of time. And I thought it'd be interesting to show you from kind of like a variety of angles why the Swiss franc might be interesting, why it might be interesting to someone who trades options or does things within volatility. And I'll take you through these kind of slides one by one. The slide in front of you here basically shows kind of like the forward prices of Swiss francs versus other currencies. And what you can see is that, the Swiss franc price is higher in the future. And this is the market pricing in the interest rate differential. And when you have an interest rate differential on a kind of like a very broad currency basis that is working against a currency, like in the case of the Swiss, you have almost like a relatively constant like depreciation pressure, as people should really be looking to take money out of Swiss francs and park them elsewhere, or rather than buy Swiss francs, buy something else. Now, the two lines on the charts, the dark line shows you today, and the kind of bluey grey line shows you a year ago. And what you can see is that these forwards actually have kind of generally widened. And as they widen, this pressure that gets exerted on the currency actually like tends to grow. The most notable one of these is on the bottom right, and that's the Swiss franc versus the yen. And what you started to see here is that the Swiss franc kind of interest rate curve is now lower than the yen, and that has flipped the forward. Now, why is this important? Generally, in a market, you've got a kind of a market that's always searching for the cheapest thing to borrow to trade against other things. And, that may be borrowing yen and trading S&P, kind of carry trading it. That may be borrowing yen and buying higher yield currencies. And what we're now seeing is that kind of baton is really kind of getting passed from the yen to the Swiss franc. And there may be like another number of other reasons where the location to kind of put that trade on in the Swiss franc is quite a lot more attractive than the yen. We'll go through a kind of couple of other reasons why here. So when we look at the Swiss franc, kind of like the price appreciation, kind of like more recently, what you see is that versus the G10, so this takes it against all the other currencies in the G10, it's had like a very strong trend, despite some of these kind of like relatively like deteriorating kind of dynamics. Now, some of this has been quite strong flows out of European countries during the energy crisis. Some of this has been kind of like Swiss inflation remaining relatively benign. But now what we've started to see is that ever since the Swiss took like a kind of like more aggressive stance with its interest rates kind of through kind of the end of 23, most through 24, we've seen that this trend has started to kind of like run out of momentum. And this is really what you want to try and see, is you want to see kind of like we're waiting to try and see more like kind of negative momentum on like a kind of a very broad cross currency basis. When we then look at kind of like what this looks like, in the last slide, I mentioned inflation. So when we look at this kind of like from a real rates perspective, what you can see is that, the yen had been very, very weak, had a very poor real rates picture relative to the rest of the world. And you can now see that the Swiss is kind of down there with the yen, kind of just on the vanilla real rates. But once you adjust for volatility, which is our charts on the right, you can actually see that the kind of negative real rate you achieve per vol in the Swiss franc is now like it's like the most negative of any pair in the kind of like FX arena. And that's really going to create a situation where if the market starts reaching for risk premium trades or things to borrow, that the Swiss franc, I think, is going to become like an increasingly popular. It's worth thinking about kind of like how this kind of Swiss franc dynamic kind of develops through time. So what I've done here is I've priced the kind of cumulative carry that you will receive for selling the Swiss franc versus the dollar. And what you can see is on the left-hand side, we are at in the 2-year space, we're at around 8%. And on the 10-year space, we're around 42%, which is the carry that the interest rate curve is paying you to sell Swiss francs and to basically borrow Swiss francs and own dollars. Now, for us as a volatility fund, where this becomes interesting is that we can somewhat lever this return by using options. Where this becomes interesting for a fund like ours, 36 South, or someone else who has access to options, is that you can see that we can multiply these interest rate kind of effects, and also have a kind of limited loss structure by using, let's say in this case, we would be selling Swiss franc and buying dollars through options. So right now, to do the kind of at the money forward, so the strike that is available in the Swiss franc 2-year costs around 4% against this kind of 8% carry. So, if nothing was to happen, you would double your money, which is pretty attractive to us. Plus also have a bet against the spot rate as well. In the 10-year rate, this kind of like gets like a lot more extreme. A 10-year at the money forward call costs somewhere around 7.5% against this kind of 42% carry dynamic, where you have a bet where a number of the kind of like factors are working in your favor. And we think that that's quite going to kind of consistently apply pressure onto the Swiss franc over time. What's been interesting, given the kind of relatively similar dynamics between kind of the Swiss and the yen now, is to look at kind of like how extreme the currency returns have been since 2020, like looking at kind of the last, just shy of 5 years, the other way. And what you can see is that from a spot performance, the Swiss has been the strongest performer against G10, and the yen has been the weakest. And then when you even account for the total return, which is on the right, you can see that, the Swiss is still eking out a positive return despite these like very, very poor real rate dynamics. And we think kind of, all in, there is some chance that there's going to be probably some mean reversion between that kind of yen number and Swiss number over time. I mentioned options on the previous slide as, a way of maybe capturing this. And what's interesting is, despite these kind of, let's say, quite gravitational forces that are working, against the Swiss franc over time, the volatility surface is still actually like very, very benign. You can see on the left-hand side, that's kind of the 2-year at the money implied vol as kind of a proxy. And we're down in the lower percentiles for how you might think like for paying for one of these trades. And even the 10-year on the right is, like very, very cheap. Now, there are various options that you have ahead of you when you have a very steep currency forward like this, where it may not be you want to take a linear bet against the currency, but you may want to swap the forward. Now, there are ways of doing this in exotic derivatives via things like dual digitals, or another trade that may be interesting to people is to maybe think about using gold versus Swiss francs versus gold versus dollars, where the forward is a lot heavier in your favor over time, and that's going to make your kind of your trade cheaper, especially from kind of a derivative perspective. I hope the kind of outlook and some of the coverage on the Swiss franc has been of interest to you. If you'd like to know anything more about 36 South or get in contact with me or the team, please send us an email to ir@36south.com. We welcome all your feedback on our content, and we will be continuing to push out more videos over time.